So it is April 26th, and I am super excited again to be here with Mr. Josh Gullick.
Glad to have you.
Super glad to be at your office today talking about the market, and then we're going to go deep into ADUs because I really want to hear what's going on, because you shared with it the other day, and I was doing my research, and it seems like San Diego is getting more and more ripe for this opportunity.
There's a ton of opportunities for ADUs. We're seeing them more and more often. There are some rules that follow the same framework that the investors are built for. There are some that are outside of that, so it's probably worth touching on because it does take some time for the underwriting guidelines for most investors to catch up to state and local laws. But yeah, I mean, it's been expanded on since really 2017. It was AB 1069, and then that was followed up by SB 9 that came out September of 2021, but really made it a lot easier to get permitted, even existing units, existing construction that may not have been permitted to begin with, but just to get a streamlined permitting process through so that you can build ADUs, add ADUs, additional units, junior ADUs, multiple units on a lot that's not already zoned for 2 to 4. I mean, there's a ton of opportunity in small construction, renovation loans, and existing properties where you're just converting.
Yeah. So let's unpack that. I just want to give a quick market update, see what's going on here in the local market and all over the nation, talk to our audience here, and then let's really unpack that. Sound good?
Yeah, absolutely.
All right, let's do it. So folks, I wrote down a few things here. What's going on in the world of real estate right now as of April 2026. Not sure when you're watching this or watching the recording. So let's talk about it. So the stale listing surge, the bad for sellers, good for buyers. In every market, guys, it's either a buyer market or seller market, what we're finding out right now. The most striking data point this spring is the record gap between sellers and buyers in many regions, specifically across the Sun Belt states, Florida, Texas. Inventory has surged. And if you guys watched my other video, I was showing you some real analytics, like in Las Vegas, it's becoming a very distressed market. Oh, wow. So there's a lot of opportunity there. So folks, if you're looking to invest, you're looking to buy, that's one of my topics I'm super excited about investing. Absolutely. And so Josh is my guy. He could lend nationwide. And so we're going to talk a little bit about that as well. Any commentary on what I have here so far?
Yeah, I mean, we've seen, there was, I would say, a pretty significant exodus out of California. The prices are the prices. I mean, that is our market, but a lot of people were concerned about rising prices and getting priced out of the market. So we've had a lot of clients go to Texas, Florida, Arizona, Nevada, Las Vegas, and you can get more affordable property there. And a lot of investment properties can cash flow positive right from the get-go. And unfortunately, that's one thing that's difficult to find here in San Diego, Southern California, or California in general. But if you can find a property, hold it for long enough, we buy here to build wealth through appreciation. Whereas in Florida, I've seen people put 25% down, cash flow positive, a few $100s a month right from the get-go. So it all is based on what your strategy is, short-term, long-term, and overall. But that's what you're the best at.
Sounds good. So the trend so far, folks, over half of all active listings right now have been on the market 60 plus days, and that's why they call it stale inventory. So when you see that, folks, if you're looking on Zillow or Redfin, anything like that, look at DOM, days on the market. And if you see 60 or more days, well, you're a buyer, you're an investor, guess what? You're in the driver's seat. So make sure you take into consideration that. Buyers finally have leverage. Nearly 2/3 of homes are now selling below asking price. If you are a seller, pricing it high and waiting is no longer a viable strategy. If you're a buyer, the bidding war era is largely over in most zip codes. So I coach and consult realtors all across the nation as well. And they're like, hey, Joe, how do I sell this listing, right? Because it's becoming stale inventory. And I'm throwing out ideas like, number one is price, right? And then secondly, I mentioned creative financing. Yeah. So I tell them about like, hey, do subject to, lease options, seller carryback. And as a lender, how do you look at that? Whenever you see something like, hey, seller carryback, seller financing, do you get spooked? Or you're like, hey, let's just make this happen?
No, I don't get spooked. It's just you're dealing with incomplete information most of the time. I know that a lot of buyers will watch TikTok and Instagram videos and they'll get half of the formula, not realizing that there are some downsides. So it's my job as a lender, as a consultant, to really give them the pros and the cons, and then the reality of timelines, the reality of what they're trying to accomplish, and if that can be done, and if it can be done, showing them exactly how to do it. I mean, the VA assumption sounds like a great opportunity, and it is absolutely a great opportunity when it works. But if somebody has, let's say, a $500,000 loan and selling a $1 million property, people don't oftentimes realize that you can't expand that loan. You got to bridge that gap. And what do? We're going to maybe do a second behind it, or home equity line of credit. Or maybe you're going to sell another property to offset that. Does the seller know that the entitlement may not get reinstated unless a veteran's purchasing it? Or does the seller know that the buyer is going to not only assume the mortgage as is, but also assume that escrow account, that escrow balance? So is everybody aware of all of these components? And a lot of times even the listing agents haven't educated the seller to that extent. Because the last thing you want is for any of these things to come up like at the very end of the transaction, and then it all falls apart after 45, 60 days of trying to get this assumption through. So there's a lot of different things there, but no, I'm not. It doesn't spook me. I just want to make sure that I have all the right information and I'm conveying the right plan for my clients.
Awesome. Mortgage rate volatility. This is another update that I wanted to talk about today. Mortgage rates are acting like a roller coaster after dipping below 6% earlier this year, which sparked a mini buying frenzy. They climbed back into the mid 6% range, averaging about 6.2% to 6.4% this month. What do you feel about the rates right now as of April 2026?
Well, I'm glad we've got a chiropractor next door because I'm getting whiplash with all this up and down. But I mean, I've always said the market's the market. Right now, what we're dealing with, unfortunately, is uncertainty. So the main driver of interest rates is going to be inflation. Now, why is inflation important relative to what's going on right now in Iran? Well, about 20% of the world's oil travels through the Strait of Hormuz, with it effectively being kind of held hostage and shut down. So that's got people spooked that the rising cost of oil will funnel into prices for everything from our, that shirt to that chair to this water bottle. So, I mean, that's a real concern, but the markets move on speculation. By the time things actually happen, as you've seen with, let's say, Fed rate cuts, by the time they cut, it's already basically been priced into the market. So what do we know? What do we expect in the next 2 days, next 2 months? I expect things to be volatile until things calm down over there in the Middle East. Once that happens, we'll start down that trend again, because I know a lot of people saw that article from Freddie Mac that was reposted. It was specifically relating to their PMMS, their primary mortgage market survey, but it said that rates had dipped below 6% for the first time since 2022. Yes, by that measure, it had, but that's where it's important to know where these numbers are coming from so you can explain it to clients. But that specific measure is an average of the rates that are passed through something called automated underwriting, or LP is what we say in the business. But whatever people are submitting on their applications, whatever that rate is, it's just taking a survey of the average of the submitted rates. So there's a lot more that goes into why maybe the lower rates are a little bit easier to obtain, but I don't want to get into mortgage bond coupons and things like that.
That'll be the next video.
We'll do it in the next video. But realistically, rates were at their lowest and still have been at their lowest around September of 2024. But we were working our way down there, and I think we will again. But this is an opportunity, I think, for people that normally would want to step out of the market or put their shopping on pause. And I've seen a lot of that. I've seen a lot of fear-based sidelining. But this is really the opportunity when you want to get in, when everybody else is getting out of the market or holding off, because you can, like you said, you're having more listings sit stale. We're moving into, or we actually have been in, like a buyer's market where you can negotiate, closing cost credits, a lower price point, things like that. I think a seller is going to negotiate when they've got 10 people bidding on the same house, or when they got 1 to 2 people?
When they have 1 to 2.
Yeah, absolutely.
I'm glad you agree. I didn't mention to you this, Josh, but I met with a mutual client now earlier this week. And guys, if you're just listening very, very closely, you could see he's not your typical loan originator, loan professional. And what he said really solidified what you're sharing here, because he was like, yeah, it was the first time you met him. And he's like, you know what, I got to run things by my accountant, my CPA. And then I didn't share this, I'm sharing it now. And he goes, the CPA was blown away by you, Josh. And he was like, wow, where'd you find this guy? So you were like talking about this code and that code and how it's going to, be in benefit to this buyer. And I just wanted to share that with you, because that was awesome, man.
I love it.
Heck yeah. That's why I'm here today. All right, so let's dive into a little bit of commercial real estate, because that's another fancy excitement of mine, is talking about commercial real estate. I love talking about real estate overall in general. With commercial real estate, the doom loop narrative for office buildings has evolved. It's no longer all office is bad, but rather a divide between the haves and the have-nots. Earlier part of this year, and I would say Q3, Q4 of last year, we saw a vacancy rate of 30+%. Especially in the Bay Area, downtown San Francisco, it was almost a ghost town.
Wow.
And now what's happening is developers, investors are creating this creative office space and making better use of these vacant buildings. The high-end Class A office, folks, Modern spaces are actually seeing scarcity as companies compete for the best environments to lure employees back. And just an FYI, folks, when you look at the different classes in real estate, like when you get into commercial, A is more like the newer, cleaner, nicer neighborhood. They kind of call it the Class A office. You really don't have to do anything. Older assets, which we call the B and C classes, buildings are struggling with high vacancy and looming loan maturities. And so this is the part where I've been really, really excited for the last couple of years, because I saw over $1 trillion plus loans maturing. And so as an investor, I see this as potential opportunity where a lot of these investors prior to, they bought at 2 and 3%. They didn't anticipate rates going from 6, 7, 8%. And so they burned through all the reserves. They didn't have enough money because now their payments doubled. And so we're seeing this exchange of investors, some of them giving the keys back, some of them going to these new investors. And that's exactly what's happening. Any comments on the commercial real estate?
Comments? No, but questions, yes. Because I don't own any commercial real estate. Obviously, we've got this office building here that I lease, but we are actually going to be moved out of this building after May of next year. They are converting these to condos. So my question is, what do you think about commercial condos? Is that, should I be investing now? How did COVID play into this? Because I know that we had everybody working from the office still during COVID on my team. That's just how we've always operated. But the rest of it, when people come into the office, we had this huge space, and I had to start the conversation off with, we're not closing down. Just nobody comes to the office anymore.
Right.
It was just awkward.
Yeah. So let me unpack that. There was a couple questions in there. And so basically what happened? So prior to COVID, everybody was normal working in the office. And then when COVID shut down, we had to keep our distance, right? And so a lot of people went back home to work. What businesses saw was, holy smoke, they're at home, they're actually more productive. So they're like, hey, let's keep them at home. Let's trim down our office space. We don't need this extra space. And that's what happened. So production went up with the employees and the offices stayed vacant. So what it means as a potential investor or landlord person, these aren't new. So when I was first exploring office condos was during the first mortgage meltdown. And so I was looking at investing at some space right there on Miramar Road, as a matter of fact. There was this big investor there that I was looking at it, and I was just looking at the numbers. And so as an investor, folks, that's really what it's going to boil down to. Does this pencil out? And so for office condos, most of them unfortunately don't pencil out, because think of an office condo like you would a house or a condo. A condo has HOA, Homeowners Association. And when you do an office condo, that variable, the Office Condo Association fee, that throws it off.
So what do those range normally?
Depends. So, it depends on, is it Class A, B, C? They have some by San Marcos, right off of Twin Oaks. I was going to make an offer. I saw one that was like a 3 private office space with a conference room, and it was just under $300,000. And I'm like, wow, this kind of makes sense. However, there was still a lot of vacancies around. And so I'm like, you know what? I'm going to go in here, and I work late. I'll be here at 8 o'clock, 9 o'clock. What about security, safety? I'm okay. But what about my potential workers? Yeah. I don't think they would be okay, right? And so the numbers were kind of there, and I always like to trust my intuition too. And so I didn't make an offer, and like a couple of years later, guess what? They're still vacant. They're still vacant. Even because the price was somewhat attractive, you got to kind of look at all those other variables. So like if you're a leader, potential landlord, owner, you got to look at the lay of the land, right? Location, they say, right?
Absolutely.
And so this office condo there in San Marcos, it was quite a ways from like restaurants and what have you. So the amenities just wasn't there to make it kind of convenient for most people. That's why I think it's not moving. And then there's just too many vacancies around it.
Where do you think the opportunity is now when it comes to commercial real estate?
Great question. And that's part of why I want to unpack the ADU part, because I think in real estate, I talk about a little bit here, and you'll see all over YouTube and these other influencers, gurus talk about the BRRRR strategy. Do you want to know what the BRRRR strategy is?
Yeah.
All right, buy, rehab, refinance, you pull your cash out and repeat, right? Mm-hmm. In commercial real estate, one of the R's, folks, is what we call reposition or repurpose. And so the opportunity for commercial real estate, folks, I would say is, okay, if you want to make a move on commercial real estate, you either want to go try it small, 1 to 4 units, which is still considered single family residence, and you could buy FHA, right?
VA.
VA. Or if you want to step it up, if you already have an existing portfolio, go 5+ units, then it's not really dictated on the borrower. It's more dictated on, does this property cash flow, does it perform? And so for the repositioning part of it, I would start to look, folks, if you're out there and if you see signs, I posted this on my one of my social medias before. If you see a sign, folks, I want you to call me or Josh. If it says for sale or lease, this person is very open and motivated to do either or. And so with that in my head, I always think as an investor, will I buy cash at a great discounted price or terms? And when they have for sale or for lease, I'm thinking terms right away, right? Where I could go lease option, a subject to purchase, seller carryback, because now I don't have to get the bank involved, right? And I do commercial lending too, so I'm not trying to knock the banks or anything like that. You know, Josh and I are both also investors, so we want to build our portfolios and we want to teach others how to do that as well. I would look at some of these office spaces and look at, like, if it's sitting at 30+% vacancy, I would think of like, okay, maybe we could repurpose this into like bachelor suites.
What's a bachelor suite?
A place where, like, almost like a studio, where you actually will turn it into, you're going to divide it into like condos, like a condo conversion, and then they actually own it. So every single unit is going to be owned by the individual.
So essentially what they're doing here.
That's exactly correct.
Okay.
So this was a Class A office building, and a lot of them, well, 100% of them was rented at one time. And so what happened was the owner decided, okay, you know what? Why don't we give the tenants the opportunity to own it? And so they set up its own parcel number, APN, and now they get to sell the unit. And say, for instance, if Josh wanted to buy it, now he owns the space. And so that is an opportunity. If you find these big office buildings, turn them to office condos, hotel, motel, you could turn into bachelor suites. And so there's so many different opportunities. I could share with you, Josh, when early 2000s, my friends and I, we were on a major run on investing. And one of the complexes we took down was in Vegas. It was a 60-unit apartment complex, and we turned them into condos. And so all these apartments, we did better walls, you know, because each city has those standards and building codes to make it like, effectively a condo, not an apartment. They're built a lot different. And then after that, we went into El Cajon, and we took down like a 10-unit, a 14-unit, and we're actually starting to see that again.
Yeah, I'm actually, my team is the preferred lender on a new development with Pacifica companies. They're doing a condo conversion in Bay Park, and those are gonna be selling for quite a bit. I haven't seen a ton of them recently, but it sounds like they're coming back.
They are coming back, folks. So you heard it right here. And this was from somebody, I like to say this, a little more of a bragging right or a credibility piece, is I'm what they call cycle tested, meaning that I've been through a cycle, got humbled pie, and I survived.
It ain't easy.
It ain't easy. But I'll tell you what, like, you want to hang around folks who cycle tested, because they're really going to pencil out the numbers to make sure, we have like 2-3 different exit strategies just in case. Because sometimes, unfortunately, what I've seen is some of these syndicators, folks out there, is basically you're pooling all these monies and you're relying on a GP, a general partner, to run the show. You park your 50,000, your 100,000, or 200,000, whatever. And in Texas, you could Google it, folks, there was a syndicator out there that had to give back like 1,000+ doors as a syndicator and foreclosed. Again, what I said earlier, he ran his numbers off of the 2 to 3% interest rate, not anticipating it going to 6, 7, 8%. He burned through the reserves. He was trying to do a cash call for the investors. They were like, no way. I already kissed my 100,000 goodbye. I'm not going to roll the dice for my another 50,000 under cash call. And that stuff's for real, folks, because I've seen it happen.
Yeah, it's good to have somebody that's actually been through it, that can see the problems that you don't even know you're going to have before you actually have them. So absolutely. Yeah.
So awesome. So I'm going to go ahead and wrap this up with this last bullet point, and then let's really start to unpack the ADUs, because I'm really excited about that opportunity. So new transparency laws, good for consumers. Several major legal changes took effect this year that changed the vibe of transactions. AI disclosures in states like California, it is now legally required to disclose if listing photos have been AI generated or digitally altered. For instance, removing a power line or adding a fake view. FinCEN reporting, as of March 2026, the federal government has started enforcing stricter reporting for all cash residential deals involving LLCs, limited liability corporations, or trusts. This is a move to curb money laundering, making high-end anonymous transactions a thing of the past. Any comments on those?
Yeah, actually that's a big one. So the FinCEN reporting, a lot of sellers will oftentimes take a cash offer over maybe a higher offer that has financing, thinking that it's a safer offer. And I always call a listing agent, and I'm always going to talk up my borrowers, but I also give them the reality, and that I've got a lot of people that invest in properties. I invest in properties. I'm going to put in offers, but if I'm just a real estate investor that's looking for the best deal, I might put 3 offers on 3 different properties, get them all accepted, and then choose which one I want.
Right.
So they're a lot less likely to move forward on a transaction or to have any kind of personal tie to that connection to make that get across the finish line. So I always argue that, but I've just actually recently started seeing people apprehensive about signing all this documentation. Like, I don't, because the seller has to sign a bunch of this stuff too. Like, you're accepting this offer and it's new to them. They're like, okay, well, I've sold other properties before. I haven't had to do this. Am I on the line if somebody's using drug money or terrorist money or whatever this is coming from? Right. So I've seen a lot more apprehension to accepting some of these cash offers. I think it could change somewhat just the paradigm with buying cash versus financing. What do you think?
Yeah, that money laundering thing is a very, very big deal. So it depends. I mean, if you're an investor, the other way I like to buy, like I mentioned, is terms. And so I would rather buy in terms than all cash. They say cash is trash. In some cases, yes. I was talking to somebody earlier, one of my clients, and she was telling me about this transaction that they got a great interest rate. They didn't have to pull money out of their stock account or anything like that. And it made way more sense to use borrowed money than to use cash. So cash, folks, there's other ways. I probably want to save it for another video, because there's this thing called arbitrage, folks. And if you have a lot of money tied up in Charles Schwab or Morgan Stanley or something like that, you could actually borrow some of that money on margin. And if you do that, and you're making a better appreciation rate and cash on cash return, it just boils down to numbers, where you just keep that liquidity in your brokerage account, borrow against it, and that differential that you're making, we call that arbitrage. So it's on borrowed money. Robert Kiyosaki talks about good debt and bad debt. In that case, that would be good debt because it's making you more money. Borrowed money, the differential is what we call arbitrage.
And I'll just add to that too, because there's another use for the portfolio line of credit. So I've got a lot of clients that work in tech, and let's just say Google, because I've got several clients that work for Google. Well, let's say Google stock price goes down while you're home shopping, and it goes down 5%. We know it's Google. We know it's going to eventually rebound, but somebody might put their shopping on hold to wait for that stock to rebound. They might miss out on an opportunity to get the house that they actually want. So I've had many people talk to whoever's managing their money. Usually has to be third-party managed for you to be able to borrow against it. But I mean, if you've got a pretty conservative portfolio, you can usually leverage up to about 60% of your portfolio, get access to that cash. Don't sell anything, just borrow against it temporarily, wait for that stock to rise back up again, and then sell it at that point. So that's a way to, that's something that I think most people, even financially savvy people, I'm certainly a lot of engineers and people that have a lot of money in stocks and a singular stock, that they just don't know about.
Yeah, you know what? Let me unpack that a little bit, because I like that. I don't know, folks. We might be losing some of you because this is very high level, but some of you are really getting it, because I'll tell you what, this is how the rich become richer. When you understand, if you've got a 6-figure, 7-figure 401k, a 403b, and you're using that money to buy property, what's the seasonality of keeping that money there to refinance and put it right back?
Yeah.
What's how many months or years?
I haven't really worked it out on paper. I know I've done it myself. It was about a year and a half for me to get that money back and pay it right back down. That's where my money came from, the down payment for my first house.
Yeah, and so what we're talking about, folks, is like I said, if you have 6 figures or 7 figures in a Charles Schwab or Morgan Stanley, people will take some of that or use it on margin and purchase a property cash. Okay, so they'll take $600,000. They'll buy that property cash, but within a year and a half, like Josh said, refinance it. Boom, put it back, and maybe by that time, a year and a half, interest rates might be at 4.5 versus 6. And so I did something very similar on one of my properties where I actually bought at 7.125%. At the time it was high, even now it's kind of high, right? And so what was really nice, Josh, I put about $100,000 on one of my properties, and I bought it stated because self-employed, and I put the $100,000 down, and it was 7%. And then when rates dropped to 3-4%, well, guess what I did?
Pull money out.
Like any smart person would do,
Yeah.
I could refinance.
Yeah.
And so I pulled my $100,000 back, right? I refinanced at a 30-year fix, like 4% or whatever at the time, and it's still locked in there.
Yep.
My payment went down. I got my 100,000 back, so I'm in at zero. And guess what happened to the property?
Continue to go up.
Bingo.
I did the same thing. I did, when rates came down, I could have saved about $900 on my payment. 900, I mean, it's a lot of money, but it wasn't gonna change my life or anything to save $900. So I would much rather have some more money. So I actually still saved $90 a month. I pulled out $350,000, put that in the stock market. Equivalent's probably about $550 now from when I did that. But I mean, it was in a sense free money because my payments still went down, but now this is growing. Value of my real estate's still growing, but now I've got 2 investments that are working for me.
There you go. There you go. So folks, keep watching, subscribing. You're going to learn a ton from Josh and I. So let's jump into ADUs. I really want to kind of unpack that because I saw that as a massive opportunity right now, folks. So if you're here in San Diego right now, please call Josh or myself, and we'd love to help you build your portfolio. We're going to get really, really down and dirty and make sure we pencil out these numbers to help mitigate the risk. There's no guarantees, folks, but what we will do is we will mitigate the risk to make sure, like, come hell or high water, you're going to be okay. So let's do one example or 2 or 3, however way you want to take it. The ADU opportunity, accessory dwelling unit. Maybe share with the audience a little bit about that and what kind of opportunities you see as a lender.
Well, I'm starting to see more and more opportunities. This really came about, and the prevalence of ADUs really came about in 2017 when the California laws changed to try to promote additional rental housing because there was a severe rental shortage. So they passed SB 1069, which basically limited the setback requirements, so you can have more density on a smaller lot without having to have more space between the houses. They got rid of a lot of the parking requirements. So a lot of areas you used to see more complex scenarios where they would condominiumize a property so that they could put more than 1 unit on it because they didn't meet the parking requirements. If you condominiumized it, you didn't have to have as many parking spaces in a sense. So you'll see this like in North Park and areas where there's just not a whole lot of street parking, but it really gave a lot of people the ability to build a property on their lot and offset their personal payment obligation even if that lot wasn't originally intended to have more than 1 unit. So this really helps in an area like San Diego where rental prices are high and they don't seem to be coming down, and there's even just a basic pay, this is the entry point. So you're not going to find really any rent for even a 1 unit place, a studio, for less than, let's say, $500 or $600. But if you build a ADU, let's say you're getting $1,200 for that ADU, let's say it costs them, let's say $950 a month to construct that ADU, and you're getting $1,200, you're going to be cash flowing positive on that. That can help offset some of your personal payment obligation. That's what my dad did. He did it with a duplex, but I mean, the concept is still the same. So my dad was living in the same place in Pacific Beach for 20 years. The landlord only raises rent 1 time. Great guy, only raises rent once. My dad was paying $1,100 for a 2-bedroom, 1-bath. It was like half of a duplex that he was renting in. And he thought life was great until he got a call in 2015 from his landlord daughter. Well, he picks up the phone. She tells him, "Hey, I know you're used to talking to my dad. Unfortunately, Dad's having some health issues. We're going to have to put him in a long-term care facility. So we will sell you the property. We won't even put it on the market. But realistically, we need $700,000 for it." Now, I wish I would have bought it back then because, hindsight being 2020 and all, but that was outside my dad's price range. So he came to me, son's a loan officer, and he said, "Can I qualify for something?" And I said, "Let's find out." So we looked at the numbers, and I told him, based on your income, we can't qualify you for really a detached property. We can't qualify you for any single unit. But if we go with the duplex route, we can do FHA with 3.5% down. He had the 3.5% down as part of his 401k. He borrowed against that. And then we can use some of the rents. We can use 75% of the rents for the unit you're not occupying as additional income to help offset that payment. So we did that. We saw the first property. It was like, this is it. I want this one. Bought that now. This is 2015. So 2015 prices, but he bought a duplex in City Heights for $375,000. Now it's probably worth $750,000, $800,000 at this point. But we were able to get him into that, 3.5% down. The total payment to start was $2,600 a month. He was able to rent the other unit for $4,000. He did raise the rent 1 time. He made some improvements on the property, put a mini split air conditioner in, so just to offset some of that cost. And that person was there for, I want to say, until about May of last year. So she's been there since 2015. Recently got somebody in at $1,500 a month, but a year and a half after he moved into that property, we got him out of the FHA loan, got a lower interest rate, got rid of the mortgage insurance. The payment actually went down to $2,200. At that point, he was getting $1,100. So he was actually back to paying $1,100 a month.
Wow.
And now because he's getting about $500 more, he's paying about $700 a month. So it's, he's loving that. Yeah. But it's the same concept where if you can build another unit on the property, or even convert a garage. That's what a lot of people will do. They'll convert their garage into a living unit, or convert if you've got a detached garage or maybe like a storage area, convert that. I mean, there are some things you need to do, like running sewer and water lines, but there are loans for that. There are actual like home equity lines of credit even that you can get that will use the after renovated value. So they'll determine, if I add this ADU, this is what we can reasonably expect as a value. So an appraiser would determine that, and we as the bank would lend you money to construct that ADU. Now you're somewhat protected because you're gonna have to submit plans and things like that to make sure that the value is there, so that when we finally originate that loan, or when we fulfill that entire loan, that for one, you can afford to pay it back. I mean, you're gonna have additional rents that are gonna help there. We're gonna know that the value is gonna be there as well. So, I mean, there's different ways to do that, different loan products that you can use for that, but that concept of having somebody else pay for or offset a good portion of your personal payment obligation, I mean, that's existed for a long time. It's just now a lot easier.
Love it. Folks, I hope you're taking notes. I want to run this other scenario to the viewers here. If you are in a 2-story and a non-HOA, you don't have HOA, you don't have CC&Rs, covenants, conditions, restrictions, and you have room in the backyard to add an ADU, and you're just thinking, hey, in the future, I don't think I'm gonna wanna climb up and down these stairs, I would really strongly consider looking into this. Right now, the market's pretty darn good. Yeah, the rates are a little bit higher than normal, but you have a ton of equity. And by that said, I would look at potentially getting an ADU construction loan, build one in your backyard. And if you're close enough, either A, you move into it and rent out the rest, right? Because I know some parts of town, you can't find a 1-bedroom for less than that additional mortgage is going to be, right?
Absolutely.
Yeah. So if I were you, you have that 2-story, you're thinking about like, hey, I want even something brand new. Well, that ADU will be brand new. Move in there. Now you don't have to deal with stairs, and then rent out your main house. And guess what? All that extra money from that main house, maybe about $4,000, $5,000 a month. I mean, if you do the math, I'll tell you what, just in my head, it would make way more dollars and cents. What do you think?
Absolutely. And there's one other concept that I've been exploring that I think me and you have talked about recently, but so for you, you're considered a real estate professional. You don't have some of the same restrictions for passive income. So for me, even though all I do is 1 to 4 family residential mortgages, I don't have real estate professional status. So I'm limited in the passive deductions. So I can't write off some of those real estate losses in the same way that you might be able to. Now, if I were to rent an ADU or rent another unit on Airbnb, it's a lot easier to meet the material participation requirements, so that, to turn that into an active participation activity to offset some of my income that's W-2. So as a mortgage banker, as a direct lender, the majority of our income, pretty much all of our income is W-2. So we don't have as much in the way of tax shelters as somebody that's self-employed or a real estate professional would with real estate. But by turning that into a non-passive activity, I can maybe do something like a cost segregation study, to basically accelerate depreciation on different components of the house and take a huge loss to offset my payment, and maybe retain. Let's say if like last year I paid $465,000 in taxes. If I did this and maybe recapture maybe $250,000, but I put $250,000 into the construction of an ADU, I just might have paid for that entire thing just with the tax savings.
Bingo.
It's like free.
Bingo. So folks, seriously, if you're a high income earner, what Josh says is right there. I mean, you're giving too much money away when you could use the tax code, these financial strategies to your advantage.
Absolutely. Yeah. I mean, why give it to the government when you can give it to yourself?
Exactly. Anything else? Any other ideas or scenarios you could think of that you wanted to share? Again, and we're going to be doing a lot more videos, Josh.
Yeah. Well, I mean, I've seen a lot of different ways to create an ADU, but I would say the most common is going to be that garage conversion. I mean, it's way easier to do. Like I said, the permitting process, even if there's an existing structure that exists that's not permitted, that's not necessarily a bad thing. So, a while ago, it was an issue to have an unpermitted addition or an unpermitted, we used to refer to them as granny flats or in-law suites or things like that. But if you've got one that, even if it's not permitted, it's pretty easy to get those permitted now. There's a streamlined process to the county or the city. You definitely want to talk to a developer, a contractor on that. But there is a pathway to get those converted, get that square footage added to the county records, and you can significantly increase the overall value of your property. I had this client recently, she just bought it was like I want to say she bought it from Costco or something, but it was like these tiny homes that you can buy from Costco, put it in her backyard in Bay Park, and she's renting that out for like $40,000 a year on Airbnb. It's like the whole thing cost her like $35,000. And so getting like $40,000 a year on Airbnb.
They made it back on year one.
Yeah, I was nuts. I'm like, I mean, she's probably a marketing genius, but because what she's renting everything else for is amazing. But yeah, I was like, that is genius. Like,
I agree. I mean, there's a lot of different resources, and just, align yourself with Josh or myself or somebody like us, because this is where the experience comes into play. This is where the mathematical numbers come into play. You know, not every lender, not every realtor is cut or, you know, the same. Right?
Absolutely.
Yeah. So I'm excited, Josh. I mean, we're going to be doing a lot more videos. Stay tuned, folks. Anything else you wanted to share before we wrap it up?
No, just looking forward to the next one.
Yeah, me too. Best way to get a hold of you, Josh?
You can call me on my personal cell. That's 619-495-9904. I'll give that to you again. That's 619-495-9904. I'm Josh Gullick with CrossCountry Mortgage and the Gullick Group.
You got it. All right, thank you.
Thanks so much. Thanks for coming by.
We'll see you guys later.
See ya.